Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park. She's the editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle. And
hey, thank you, Jim.
And happy spring.
Yes, isn't it exciting?
Well, I knew it was springtime because the allergies are back.
It's still pretty freezing cold in Ontario, but hopefully the sun will have its way.
You see, I keep forgetting what it's like in the rest of real Canada.
Right.
As I call it. But I was watching the news, and every place they did a story, there was still snow on the ground. So
yeah.
Here, they had the weed whackers out. The gardeners were busy outside my window. So they just finished working, so you can't hear them in the background. But believe me, they were there a moment ago. Danielle, the U.S. Fed raising rates again. The Bank of England, interestingly, did not raise rates yesterday. So why the difference between the U.S. policy of raising rates and other countries trying to hold them down?
I think everyone's very nervous about the impact of the trade changes that are going on, the tariffs, the protectionism, and how that might curb the global growth rate. Certainly the Bank of Canada cited that this month as the reason they paused as well in their rate hiking plan. And I think that, it's basically there's a general theme in the world of tightening monetary policy. This has been going on since December of 2015 when the U.S. Fed began hiking rates. And we've seen other central banks in the world taking additional steps at different rates, but all with this intention. Their story remains the same. They say we've given emergency support for many, many years now. It's time to get off low rates. We need to normalize. Their narrative is that the economy is doing well and they see only good things coming, so that they have no excuse not to raise rates. But the reality is, as we've talked many times, when you come from such a low level, it's not that rates are historically high yet by any means, but when you come from the zero bound that we have been at, the relative price change is exceptionally large. So just to give you some perspective about this, so if you remember, Jim, in the emergency aftermath of the Great Recession, central banks, especially, for example, the FOMC, took their target or Fed funds rate to 0 to 0.25 was the range. And this was something that had typically, before the Great Recession, been in the 5% range. That was sort of the normal cyclical 5.5 in there. So we took it all the way to 0 to 0.25. Now, in the move that they did yesterday, they've increased now 6 times by 0.25% in the meeting since December of 2015. They're now at a range of 1.5 to 1.75, which sounds very mild. As I say, historically these things have been in around 5. But if you think about that, it's a 600% increase in the Fed funds rate since they started their tightening mode in December 15. So you see this kind of impact all over the place. And the reason Fed funds rate matters is it impacts the prime lending rate. And the prime lending rate is used as a base rate for consumer credit and business credit, the rates that banks offer their customers. So no, those rates have not escalated by 600%, but they have definitely increased, and they are on this increasing path that every time the Fed funds rate is increased and the central banks increase these base rates by which banks borrow from one another or borrow from the open market, the central bank on an overnight lending facility, typically banks want to make a spread, right? So if they're having to pay more to each other for borrowing, then they're going to increase the rates that they're then lending to their customers. So all over, you get this raising rate environment. And it's impacting things like, the 5-year mortgage rate in Canada, which is, of course, something like 66% of Canadians have fixed-year mortgage rates of 5-year terms. And those rates have been going up as well. Again, relatively still not very high historically, but relative to where they were, we've seen a significant increase. So already people are having their mortgages come up for renewal and facing a higher rate, and it's something they haven't seen, for 20 years. Basically, we've had falling rates all the way from the 1980s, and every time someone's mortgage came up for renewal, they were able to renew at a lower rate. And so what unfortunately happened is they didn't just renew at a lower rate, they borrowed more. They refinanced. If we look at the mortgage broker information, it suggests that something like 80% of the mortgages that were done or that were renewed in the last 5 years were actually refinancing, meaning they increased the dollars that were borrowed against their homes. And they did that to fund other spending, to, pay off other debts, to do crazy things like borrow against their home and invest in securities and real estate. So they've really been on this binge, and so now they're getting this rate shock where they're having to either, stay where they are because they don't meet the new stress tests, or they don't, they can't move to another lender without meeting this new stress test that is now in the system, or they are faced with higher rates. So any way you look at it, costs are going up, and businesses are facing higher borrowing costs, and also things like LIBOR, which is, it determines the cost that corporations borrow at. It has spiked significantly in the last few, the last 31 days. It's gone up every single day. And so that is a shock that's hitting the system. It's a predictable shock because we knew that when they went to, next to nothing as rates, that it was going to be a very painful climb back up. And that's in fact what's happening. So you've got some central banks talking the brave, trying to not blink, like the FOMC yesterday under new Chair Jerome Powell. He's wanting to talk strong and confident and, promote confidence in his positions and powers. But at the same time, I think that they're living in a dream world because they're not appreciating that this coordinated tightening all over the world, when the world is the most indebted it's ever been, Jim, as we've discussed many times, on every single level. So you're just quickly evaporating any cushion that was in the income of households or the, revenues of corporations, when you have this massive tightening of monetary conditions and borrowing rates all at once everywhere. And I think that coupled with the tariffs, which are increasing costs and decreasing trade, will impact revenues and exports. So you really have a sort of a major unraveling of the global growth story going on in the world right now for all these factors.
Well, President Trump said he wanted to get his infrastructure program up and going, but if the cost of steel and aluminum has gone up 25% for steel and 10% for aluminum, how do you afford that infrastructure program?
We're going to have to afford infrastructure investment, but you're right. I think, this is the general theme. Costs are going to be elevated across the board because borrowing costs, because investment costs, because there's been so much waste and redundancy put into the system, inefficiency by misallocation of resources over the past several years. So, we've kind of been living in a fool's paradise where people have been saying, oh, look how prosperous everything is because everyone could buy everything or achieve things on cheap credit and short-term focused policies. But now what we really need is some long-term focused policies and reinvestment. And so absolutely infrastructure is a critical factor. I'll give you one example. Water costs are skyrocketing in many cities. Where people are, having to pay their water bill has gone up something like 500% just in the last 5 years. So it is definitely something where, and the reason is that there's been insufficient investment in upgrading many of things like sewer and water systems in cities all across North America. And so who's shouldering the burden of that the most, of course, is the people that have the lowest income and the less ability to just absorb that kind of increase in cost. But ultimately, it's going to be felt across the board. And so there's only so long you can defer some of this investment until it's literally falling down around your ears. And I think that's where we are with a lot of it. So this is going to demand, because things like essentials like water and sewer and, these items, are going to necessarily demand that money is spent there. Now, unfortunately, there hasn't been much put away for this investment in terms of capital set aside. And that's why there's so much debt financing that is needed for these kind of projects. But ultimately, it just means there'll be less money for personal consumption, for, frivolous spending, for, having, like massive retail sales of consumer goods and things. You're just going to see a general less capital available for that kind of spending. And we're already seeing that. Retail sales have dropped in the last, since November. And I think that it's because of these, like we say, the increasing cost, not just of mortgages, but of all kind of consumer credit, which is, cards and auto loans and everything has gone up, and so people have less money left over. And this, massive amount of mortgages coming up for renewal that are going to, have to be dealt with, and all that, it just reduces the amount of funds available. So it's going to mean that some tough decisions are made. People have to go back to saving, Jim. That's the other thing. The savings rate has been back at, pathetic levels, like all-time lows, as people have been reaching to buy these, new cars and insanely priced homes and all the goods that go with that, the maintenance, the utilities. There's just been not enough cash flow available to also put some away for a rainy day while you're servicing all that debt. So that's going to have to change, because, as I say, savings is directly related to investment available in the world for everything that is essential to keep society supported. So we're going to have to make some hard decisions, and yes, costs are going up, and that means we're going to have to cut out certain kinds of waste that we've been sort of have been widely common in the past few years.
We'll have more with Danielle Park right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome back. We're speaking with Danielle Park. Danielle, could one of the reasons that they want to raise interest rates be that pension funds right now are making very little money on stable investments, so they've had to go into the equity markets? If you get a return of 8% on your savings account or in a pension fund, is that sustainable, and is that what they're trying to do so that pension funds actually have enough money?
Well, a return of 8% interest is impossible in this climate without taking on extraordinary amounts of capital risk. It's just not. Everything's priced off the risk-free rate, which is essentially, starts with the overnight rate, goes up to prime rate, and then every other type of credit facility is priced, a certain spread above prime. So if a prime rate or a Fed funds rate is at 1.75 and a prime rate is at 2.25, then, everything will be a function of that. If prime rate is at 5 or 6%, then much higher rates are going to be available or paid on different kinds of credit. So it's definitely connected to those underlying rates. So we're nowhere near, 8% levels, but the problem is that it's a completely unsustainable model to have everything priced as if money is worth nothing. And that's why, they did that in the aftermath of the credit bubble bursting the last time to try and buy some time in the hopes that banks would be able to sort of recover and, build up their coffers again. And they extended the cycle. There's no question. But the problem is that it's really given rise to this this speculative mania, this sort of trust-abusing environment where everything was, I'll give you an example. It's tied into the story we're seeing with the Facebook fiasco, with, the selling of the private information to be capitalized by certain organizations. This abuse of trust, selling flow, selling info, secret profits, conflicts of interest, double dealing, this has really become the dominant business model of our day. We see that all through the social media, the free apps and things that, we actually are their product that they sell to other people, and we kind of naively sign up and go, oh, it's free, how cool. It's the same thing with the financial system where, for example, all of the order flow of trusting customers with their broker-dealers, the broker-dealers turn around and sell that flow to predators in the HFT realm who take advantage of it, front-run it, make skim profits off of it, So this it looks like it's cheaper for the customer, and people say, great, my costs are next to nothing on this, but the whole point is they're being used as, pawns in a scheme, and that scheme ultimately has eroded all sense of trust or reliability. So we have a very fragile system in many places in the world where we need to have a more robust trust-based system. And I think that getting interest rates back to have some fiscal discipline is essential because then people make correct decisions. Like if you know the cost of something, you say, well, gee, it's not worth that cost to me, or let's find a way to lower that cost. When cost is next to nothing or hidden, people make much different decisions. So I think getting risk appropriately priced in the world is essential. And that is tied back to this idea that interest rates have to make sense. There has to be spread. There has to be correct pricing of risk off of certain bases that are not just manipulated but actually part of a free market system. So that's kind of a long way of answering your question. But yes, these pensions and insurance companies and funds that are required to promise a certain payout, or they're supposed to be responsible for ensuring a certain stream of income to people who they've entrusted with, this job and this commitment, are in a very almost an antiquated model in this world that we're in, right? Where that they used to be a sort of it was a given that these funds could keep their risk low. They could buy things like government bonds. They could earn a certain amount of interest. That interest would be compounded, and they wouldn't have to take on a great deal of equity risk, if at all, because they would just have enough funding coming in terms of savings and contributions, and then the interest compound effect was significant, and they were able to make the payout commitments. In the world we've been in, where rates have been zero, where the amount of people expecting to be paid out has now tipped to more than the people that are paying in, where, the price of risk has been wrong, where they've been pushed into riskier areas and lost principal in two big market blowouts so far in the last 15 years. All these things have really corrupted this model and made it so that it's not sustainable. And all across the world, these as I say, funds and institutions that were supposed to be the foundations of trust and social support have really been eroded greatly. So either we're going to have to, wipe them out completely and no one's going to get the benefits, or we're going to have to restructure them completely. And part of that goes back to the correct repricing of risk. The other part of that is the going back to full disclosure, not allowing all this abusive trust and illegal antics to go on, getting the financial system pushed back into, subservience to the real economy instead of dominating and pariah-like activity that sucks all the value out of everything. We really have a major tipping point here.
We'll have more with Danielle Park right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, a study has found Canadian banks are still putting a lot of pressure on their employees to sell products to their customers that they don't need or would not be in the financial interest of that customer. Do we need more regulations there, not less?
Well, what we need, and I've been saying this till I'm blue in the face, but it's so obvious, we need a division between the deposit-taking institutions and the sales arms. This is the securitization, the conglomerates that underwrite and sell products cannot be the same people who are taking deposits and, quote, advising consumers on how best to conduct their financial affairs. The banks have become these massive sales machines which are in the business of selling debt and risky products for savings. And if people don't take debt and they don't want to put their money into risky products, the banks don't make any profits. So they have taken the cap of advisor, all while their true motive is to get everyone into as many products as possible. We've seen this time and again. In the Canadian banks have been, subject. The CBC started the undercover study a couple of years ago. The Financial Consumer Agency then was embarrassed into having, which is this, supposedly oversight of the banking system, was embarrassed into having to do this investigation. So no surprise, of course, they came to the conclusion that there's not sufficient controls in the biggest banks to prevent sales of financial products being misrepresented, that are unsuitable for consumers. They say, hey, the banks have a sales-focused culture, and they push their employees to flout flout all the consumer protection rules. Well, there's no surprise in any of that. We've known that for years. We've had many confirmations of that. We've had the undercover studies. We've had, all sorts of anyone that's outside the system that can look at it and comment on it says, hey, this system's very devastating. And indeed, we have the record Canadian debt levels at, more than 1.8 trillion just in household debt today, the highest it's ever been, just to show that the banks are exceptionally good at selling risk and doing financial harm to households. So there's no question of any of this. The only question, Jim, is, as I say, how will we summon the public ire and political will to actually get these institutions carved apart again, just as they were in the Glass-Steagall Act of 1933, where they actually were able to divide them up and say, we can't afford, as a nation, as a society, to have the advisors doing the selling. We have to have advising on one side and product choices completely separate. So we need to do that, and unfortunately, as we've seen in the under the Trump administration, they once more put a kibosh on the fiduciary duty rule, which was coming in to require that retirement advisors only have the best interests of their clients first, that they put their advice to them as the priority, not as what fees are going to be the greatest to them and the advice that they give. So that was coming in. Trump has put that on ice again. And secondly, there was a big bill passed in the U.S. Senate this week to roll back the Dodd-Frank requirements, which were, they sort of skirted around trying to make banks a little more accountable, but they didn't go far enough because they didn't divide them as required by the proposed Return to Glass-Steagall Act, which was put forth in 2013 in the U.S. Congress through, John McCain and Elizabeth Warren and several other bipartisan senators who said, hey, clearly we need to break up the big banks. So there's been still no political will, and in fact, it's still all going in the wrong direction. But I think what's going to happen here is, you're going to have a major blow up in financial markets. We're certainly due for that, and that will once again bring to the surface the reality that until we break up sales from advising, we're going to keep going down this very dangerous path.
Is it any coincidence that the biggest contributors to both the Liberals and Conservatives in Canada are the major banks?
No, it's not a surprise. It's also that, because they have the most profitable business models, they have this abuse of power is inherent in their model because they can they infiltrate all the regulators, self-governing bodies, they stack boards and committees that are supposed to be overseeing them with industry-friendly people. They have the money to pay off and corrupt and queer. I mean, it's just, I wrote an article, I think it was last week, about the trust busting days that were, prevalent under Teddy Roosevelt, when they essentially just said, the government said, okay, we've got some companies that have got too big to control. They are conglomerates. They are infiltrating every institution, every government level, every regulation, and it's clearly everything that's good for the overall economy, anti-competition, anti-regulation. They're impossible to enforce laws and that sort of thing. So they ultimately broke them up into smaller conglomerates, and we need to do that again, clearly, because there's just no force that has enough teeth to combat when they control this much of every level.
Danielle, thank you so much for chatting with us.
Hey, thank you.
Our guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. You can forward questions for Danielle or any of our other guests to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.